Welcome to Investing Compass. Before we begin, a quick note that the information contained in this podcast is general in nature, does not take into consideration your personal situation, circumstances, or needs.
I'm actually really excited for this episode today, Mark.
So you're not excited for all of them?
I mean, most of them I am. I wasn't really excited for that half an hour where you compared yourself to an income statement.
Well, I think that's stretching things a bit, mate, but point taken. Next time I talk about a financial statement as an analogy, I'll be prepared for what? It's been like 2 years of ridicule now? Yeah. Okay. And anyway, why don't you tell everyone why you're excited for this episode?
Okay, so this is going to be one of my favorite episodes because one of our listener favorite episodes was when we talked about how to create a goals-based portfolio. And today is a good extension of that episode.
I think that was a good episode as well.
Yeah, and it's one of my favorite episodes because we all believe that investing is about picking individual shares and ETFs. But in reality, that is only one component and not even really a necessary one. We invest to achieve goals, and the largest influence on if we achieve our goals is knowing the return needed to get there and selecting an asset allocation that has a reasonable chance of achieving those returns.
An asset allocation is a huge driver of returns, far more than security selection. If you're trying to get an 8% return a year and you allocate 90% of your portfolio to cash, you just aren't going to get there, no matter how great of a stock picker you are.
And this is about framing risk appropriately. We're sold on the notion that risk is when your portfolio goes down in the short term, but in reality, risk is not achieving the return you need to reach your goal over the long term.
Which you've been quite vocal about and something that you said that you counseled a lot of your friends on.
I do. Many of my friends are so wary of the risk of investing in the share market that they keep the vast majority of their savings in cash, which feels safe but makes it next to impossible to achieve long-term goals.
Okay, so today we have a guest episode, Shani, another one. So this is our fourth, maybe?
Our third, I think.
Okay, and we have Matt Wacher. And so Matt is the Chief Investment Officer of Morningstar Investment Management for Asia Pac.
Which makes him kind of a big deal.
Yes, it does. So among other things, Matt and his team are responsible for setting our long-term and shorter-term expectations for the returns of different asset classes. So this should be a fascinating conversation about how investors should incorporate this into their financial plans.
And please go back and listen to our episode on goals-based portfolio construction. But the 10-second summary is that we encourage everyone to set goals and be specific about when you want to achieve it, how much you'll need to achieve it, and how much you expect to save. That'll allow you to calculate the return you need to achieve that goal, which means that you'll have the basis for selecting the right mix of asset classes to get that return.
All right, so with that background, why don't we just jump into the interview, Shani? So we are continuing our series of having guests onto the podcast, and we've got a really exciting one today. So I'm very pleased to welcome Matt Wacher, who is the Chief Investment Officer for Morningstar Investment Management in Asia Pacific. And Matt, so we have lots of titles in this industry, and I think we all know what they mean, but a lot of listeners don't. So what is a Chief Investment Officer? What do you do day to day? I mean, what is your job?
Well, thanks for having me on, Mark. And it's a very good question. I guess, in principle, I manage the investment team here in Sydney, and I have some staff in Japan and India as well. And my day-to-day role is really helping that team make better investment decisions. And so, we spend lots of time thinking about the portfolios that we run, thinking about the research that we do, and I've got lots of very smart people in the team, way smarter than me, and it's really about my experience and bringing that to bear and thinking about things maybe in different ways, helping them make better decisions. So that's kind of the key part of my role. I manage a portfolio myself. It's quite an unconstrained portfolio, so we get to do lots of interesting things there, and I leverage all the research that my team does as part of that, and of course supporting clients, doing webinars, things like that. Going out and meeting my clients, understanding what interests them and how they how they're feeling about what we do as an investment team and making sure that we're doing all the right things for them as well.
Okay, great. And we'll get into a little bit of the investment side in a second, but Matt was actually recently featured in the AFR, and we have it hanging in our kitchen. I don't know if that's embarrassing to you.
It's very embarrassing.
But it goes through your background a little bit. But for everyone else who hasn't read that profile, how did you get to this role? What's been your career path so far?
I think I said in that article, and I'll say it again, I don't know how I ended up here, sitting here talking to you now, Mark, as the Chief Investment Officer at Morningstar. It certainly is probably a non-traditional path to this type of role. I guess I started out my career in the financial markets. I was an options trader, and that gave me a great introduction into asset pricing, albeit of something complex derivative that not many people really understand. But it gave me a really good handle on risk and those sorts of things. But it's also it was a very narrow type role. There's lots of maths and not very exciting things like that I had to engage with on a daily basis. And I managed kind of big portfolios with my team. I was only the junior member of the team in those days, but for banks and other types of firms. And I did that in Sydney, London and Tokyo as well. I spent some time there. But really, I think the key part of my career, I pivoted for a while and left the financial markets. I went back to university and did lots of, I tell everyone I tried to use the other side of my brain for a while. I did lots of philosophy and things like that. And that really set me up for kind of to think differently and really deal much better with the grey areas. And you find that in investing that everything is grey. I think anyone that there's often a false precision to what people do, and actually there's much more grey around the edges. And so I think it sets me up for my role now, having gone and spent some time out of the markets and done different things for a little while. And it all ties together in this role that I kind of navigated this path of doing a few different things. But when you think about, Matt managed risk in the past, and he thinks about things a little bit differently. They're really all tied together. And I guess that's why Morningstar employed me.
It's hard to tell always, right?
That's right. But yeah, I mean, everything I've done in my career, I can kind of piece together and say, okay, I understand why I'm here right now.
Morningstar Investor is built for investors by investors. It provides independent research and data on over 40,000 securities, tools to build and maintain an investment portfolio, and investor education resources to support you, regardless of where you are in your investing journey. Explore opportunities with our monthly global best ideas. Explore our ETF model portfolios. Plan better with 2 years of dividend forecasts for ASX-listed stocks. And stay informed with independent thought leadership. We've built tools to help you construct, monitor and maintain your portfolio, including our Portfolio Manager, integrated with one of Australia's leading portfolio tracking tools, ShareSite. Morningstar has been empowering investor success for over 35 years. We're passionate about your outcomes and are here every step of the way as you achieve them. Take out a free 4-week trial to access our resources. Find the details in the episode notes.
Okay, great. So let's move into a little bit of the investing side of things. So in the intro to this episode, and then throughout the different episodes we've had on Investing Compass, we always talk about the importance of a goals-based approach. And we, of course, encourage listeners to define their goals, figure out what return they need to achieve them, and then that goes into asset allocation, which gives you a chance of achieving those goals. So sort of central to this and central to asset allocation is expected future returns for different asset classes, that mix you want to have in your portfolio. So that's something that you guys do, that Morningstar Investment Management does. So what is the process for estimating those future returns that we'd get from different asset classes?
Yeah, so I mean, it's fundamental to everything we do is understand or getting a handle on what we think, the intrinsic value, the fair value, as it were, of an asset is. And so by an asset, I'm talking about a stock or a group of stocks, more likely for what we're doing, the Australian equities asset class, for example, or bonds or even a currency property, listed property, for example. So when I talk about assets, and that's what I'm talking about here. And we want to get an understanding of, what do we think is a fair return, a fair value that we can achieve from this asset, Australian equities over the long term, really ultra long term, the next 50 years. And if you look, for example, at US equities, if you look back in history, they've delivered about a 9% return per annum. That includes inflation. And, so we'd say, a fair return for US equities is probably about 9%. And then we kind of peel back the layers and we say, okay, well, how do we get to that fair return? And it really comes down to what I'm going to call fundamentals. And that's really the cash flows from a business, how a business, returns capital to shareholders. And so, you get dividends and you get buybacks. Buybacks very prevalent in the US, less so here, but in Australia, but there are buybacks quite often in Australia. But dividends, what's the dividend and buyback? What's that cash flow yield that you're going to get, from a company into the future? And then how's the company or the asset class able to grow those cash flows, grow those dividends and buybacks, as it were, for the equities, for equity markets. And so you come up with, what we think is a fair rate of return into the long term. And then we look at, okay, well, what's the starting point now? So valuation comes into it. And if we say, well, we think that actually Australian equities or US equities, whatever it might be, have either been over or under earning for a period of time against those fundamentals. And so we think that, and the price has now gone up above where we think it should be or below where we think it should be. And we'll come up with a fair expected return. And so that might be, well, we think the long-term return for US equities, including inflation, is, say, 9%. But at this point in time, because it's done X, Y, and Z, we think that actually now you're only going to get about a 2 or 3 or 6% return, depending on the environment that we're in.
Okay, so let's start long-term, and then we'll talk about right now and where you see opportunities. So, if we look long-term, and I think you guys put together a 20-year projection of returns. So you've actually got a slightly higher return for Aussie equities than US equities over that period. Yep. What drives that?
So for Aussie equities, as an Australian investor, there is a tailwind that you get from franking credits. So you would expect, as an Australian-based investor, that you can pick up from the tax benefits effectively that you get from investing in Australian equities through franking credits, through the dividends that you receive, that you'll get some tailwind above and beyond all other global equities. That doesn't necessarily mean at any particular point in time that's a better or worse opportunity. We factor that into all of our expected returns. But that's why you've got a slightly higher long-term return for Australian equities relative to US equities.
Okay, great. And one sort of last question before we get into current opportunities. We have, and one of the things that we talk about is a strategic asset allocation. So that's really looking at sort of the, I guess, long-term asset allocation that you guys are aiming for. But then there's this tactical asset allocation, right? And that's based on attractiveness, right? That's at the current point in time. So I guess, what is attractive to you guys now? Is there areas of the market, whether that's an asset class or a country, that you think is more attractive right now and things you don't think are attractive? Yeah,
and it's very interesting because the portfolio that I run doesn't actually have a strategic asset allocation. It's completely unconstrained. And so really you're trying to, exactly as you say, find the best opportunities for the risk that you think you need to take. So you're really trying to think, not necessarily being tethered to a strategic asset allocation in that environment. You're thinking, okay, well, how am I going to be rewarded for the risk that I take in any position? And you do that also with a strategic asset allocation, but you have to keep that SAA, as I'll call it, in mind. And so where we think the opportunities are now, we think Australia is not a bad opportunity, like relative to recent past. We think there's about, not including inflation, above inflation, we think you're going to earn about 2.5% over the next 10 years per annum from Australian equities. And that's like looking back at this time last year, we thought you were going to have a negative expected return for Australian equities over the next 10 years. So it's improved, but there's other areas that we think are even better. And some of these areas you're not going to put your whole portfolio in. We think China equities, in particular Chinese tech stocks, are very interesting at this point in time. Brazilian banks and miners, or Brazil in aggregate, we think is a good opportunity. So Brazil's an interesting opportunity because what we're thinking is, we'd rather, even taking into account emerging market risks and all those sorts of things, we'd rather own Brazilian banks and miners at this point than potentially Australian banks and miners. Doesn't mean we won't own any Australian banks and miners, but we want to have something there that we think we can generate a bit better reward for our risk, owning some Brazilian banks and miners, for example. We also think Europe's done very well just lately. But we did think at the start of this year that Europe was a good opportunity. And we think in the US, we've got our highest weighting to the US that we've had for many years at this point in time. We think the US is a reasonable opportunity, similar to Australia, but there's parts of the US market that we think are very attractive. And that would be areas like communication services and even some of their financial stocks as well, we think are very attractive at this point in time. And you're going to get a very, very reasonable expected return out of those parts of the market. Communication services, I should add, specifically stocks like Facebook and Google or Alphabet and Meta as they are these days.
Yeah, everyone gets very confused about communication services because everyone considers those tech stocks.
That's right.
But they're not actually in the technology sector.
That's right. I think it's been about 5 years that they got shunted out of the the IT.
Just another thing to confuse investors,
exactly.
right? So you were one of the speakers at our conference, and I think, this was sort of implied in what you were just talking about, but you gave this really interesting presentation. You were talking about valuation and talking about how valuation impacts future returns. And we do talk about that a lot on this podcast, but many investors do the opposite, right? So many investors chase returns, and oftentimes if you have outsized returns, some of that may be from earnings growth, some of that may be from dividends, but a lot of it's just from valuation increases. And so can you talk a little bit about how valuation plays into that? Because we try to make this point, right, that higher valuations could be lower expected future returns. Like, how does that work and how does that inform your investing process?
Yeah, I mean, I think it's actually central to everything we do. And I'd say that we see ourselves as having some, because we have a fairly rigid, investment process or fairly structured investment process, we think that we have a behavioral edge over other investors. I mean, we don't think we can out-analyze a stock or do anything along those lines. We think, we want to have a very systematic or structured process, not systematic process. There's discretion within it, but we want to make sure that we stick to that process, and that gives us a behavioral edge. So fundamentally, we believe that you need to be different to the crowd. You need to look at valuations and do fundamental analysis and really have a contrarian mindset. And that's going to help you earn much better investment returns over the long term if you're doing things different to the crowd. And that's not just for the sake of being different, but we think that we really want to be buying assets when others are selling them or selling them when others are buying. And that's because we think that that's where mispricings occur. And when everyone's doing the same thing, invariably you get this herding mentality as you were kind of describing. And, that then leads to these mispricings. And we think, okay, well, now would be a time to sell an asset into that if you're holding it, or if on the other side of the fence, if everyone's super risk averse, then you want to be buying assets. And so what we try and do in those sorts of circumstances, are we wrong? Is everyone else right? And so I'll give a simple example that people might understand. We haven't actually done this piece of work specifically, but I thought it was a good example to give you. If we think about Apple as a stock and say it's currently priced at about $145, so we think, well, is that appropriate? Is that expensive? Is that cheap? We can do some work on that. But really, what are the assumptions that people are making buying Apple at $145? What kind of sales does it need to generate to deliver those kind of returns? How many iPhones does it need to sell to deliver on that price into the future? And you think, well, is that realistic or is that not realistic? We had a similar example on the other side of the fence when we owned some energy stocks after COVID, and energy stocks were priced as though no one was going to fly or drive or anything ever again. And so we were thinking, well, is that likely? And it could have been in COVID. There was a lot of uncertainty around then. But we thought, well, let's assign a probability to that. And we thought the probability was probably reasonably low, so we could buy some cheap assets on the other side of the fence, not, again, doing the opposite of what the herd was doing. And then you lock in some pretty significant returns there. And on the other side of that trade, there was people buying Zoom and Peloton and things, that thinking that they were going to be locked down forever and, no one was going to go back into offices. And we thought that got, stretched to your example. So I guess we're not trying to be different just for different sake, but we think that difference, being different, you can take advantage of mispricings. And we think that that's not a skill set that we should just have. Others can do the same. And when there's herding mentality, when there's these behavioural biases that appear in the markets, we tend to want to be on the other side of those.
Yeah, and I think two of the really interesting things you said, we did an episode actually on edge, and we went through the different pieces of edge that an investor can have. And the behavioral one, I think, is great because it's something that anyone can do, whether you are investing. It doesn't make it easy, but whether you are investing on your own, you can have behavioral edge, whereas analytical edge is much harder, right? So analytical edge means that if you're a mom and dad investor, you have to be able to out-analyze all of the professionals that do this all day, every day, that have all the training. But yeah, behavioral edge is a great one.
Yeah, and I think that as I say, that's where our edge is. As I said to start, we've got lots of smart people in my team. But I also said throughout this podcast that there's lots of grey in investing. So the right answer is sometimes not even the right answer in financial markets. You've got to be humble.
Yeah. And then the sort of second thing, and I think the Apple example is good, and also the energy during COVID example is good, is, people need to understand that, of course, the market's looking forward, meaning expectations are baked into a share price. And I think people lose sight of that, right? And the higher the valuation level, the higher the expectations. And it isn't really how the company performs, right, on an absolute basis. It's how it performs compared to those expectations.
That's exactly right. Yeah.
Well, great, Matt. This was great. Thank you for coming on. Very helpful. I'm sure everyone will appreciate listening to this. So thanks for that.
Thanks for having me on, Mark. Really appreciate it. Hopefully
Absolutely.
It was useful.
Yeah, no, it definitely was. And thank you all for listening. So we always say, my email address is in the show notes. We would love any comments you want to leave on your podcast app or ratings. And thank you very much for listening.
Any advice in this podcast is general advice or regulated financial advice under New Zealand law, prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited, without reference to your financial objectives, situations or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.